Just as we saw Mike building a pipeline of maple syrup, you can do so using real estate. Quick disclaimer, this is not intended as legal, financial, or professional advice for your personal financial situation. Information presented is believed to be factual and current. It should not be regarded as a complete analysis of the subjects discussed. They say the best time to plant a money tree is yesterday. The next best time is now. Now, in Robert Kiyosaki's book, The Cash Flow Quadrant, Robert outlines the 4 different quadrants in which people typically earn their income. We have the E quadrant, which stands for employee, S, which stands for self-employed or small business, B, that stands for big business, I, which stands for investor. An employee has a job, and a self-employed person owns a job. On the right-hand side of the quadrant, big business has systems that make money, such as a series of employees, procedures, or manufacturing processes. There's a system in place used to create revenues, and for the investor, their money works for them. On the left-hand side, that is active income, and on the right-hand side is passive income. We want to go from the left-hand side of the quadrant to the right. Passive income is truly money earned while you sleep. People from across the world seek passive income because it can help offset some of their expenses. If a person earned $500 per month of passive income, then they might use it to pay for some of their groceries or phone bills. Some even reach a point known as financial freedom or financial independence. This is a state where your passive income is high enough to live on. At that point, you could quit your job, pursue the business idea that you always wanted, or simply work a little bit less. In essence, you can have the economic freedom to do more of what you please. Robert Kiyosaki says, "The problem with the world is there's not enough problem solvers. When you solve problems, you become rich." The maple syrup farmer believes in creating systems that's going to make his work easier. He understands that it can take several years before the system is built, and they're going to continue harvesting the maple syrup produced from the maple trees. The maple syrup farmer does not cut down the maple tree to sell the lumber. Here's the history of a real estate housing problem in Canada, and we're going to show you how solving it can lead to profits. Before 2008, Canada had very different mortgage rules today. There used to be zero down mortgages, including 40-year amortizations, even cash back on mortgages with zero down. And you could have as many mortgages as you wanted. That was all before 2008. After 2008, no more 100% financing. You cannot take more than 35 years to pay for a property, and believe it or not, they introduced minimum credit scores in 2008, right around the time of that whole collapse in the US. The rule makers shortened the time down to 30 years to be able to pay for a house. Then the rule makers decided the maximum time to pay for a house would be 25 years. The effect from reducing the amortization means that the overall monthly payments for a homeowner's mortgage goes up. Tougher guidelines for self-employed people were also introduced. All in all, this is making the dream of Canadian homeownership much harder for the average person to be able to achieve. Then minimum down payments went up on purchases over $500,000 in 2016, as well as there's now a stress test that was introduced for higher ratio mortgages. And shortly after, then they decided to make it apply to all mortgages, no matter how much you put down. This means that the dream of owning a home is harder and harder for the average family, but they still want a home. More and more hardworking Canadians are being turned down by the banks, and they can't finance a home. The solution is alternative home finance. Owning real estate and selling it as a rent-to-own allows us to profit while solving a housing problem. Who is rent-to-own for? Rent-to-own is for new Canadian immigrants, people who may be recently divorced, people with not quite a full down payment. It's also for self-employed, but they do need to be working. This is a program for Canadians, built and founded by Canadians. This is how rent-to-own works for our buyer. Our buyer goes through a screening process. Once approved, they have a starting deposit that they're going to use to secure their home. They're going to pay rent each and every single month, as well as they're going to pay into what we call a forced savings account. That gets added to their starting deposit. Typically, after 3 to 4 year period, their starting deposit plus their forced savings adds up to become enough for their whole down payment, and it's the end of the program. They're going to buy the house and become full homeowners with a regular mortgage with a regular financial institution. This is how rent-to-own works for us. We get a very large starting deposit, much more than a traditional buy and hold property. Our buyer is going to be adding money every single month to that starting deposit, and 95% of the growing deposit is non-refundable. That means if they don't buy the house, we're able to keep most of it. We receive rents every single month, and there can be some cash flow from that. Also, our mortgages are getting paid down every single month that we receive those rents. And then at the very end, we're going to get the difference between what's owing and the final sale price, and that becomes our profits. Some of the benefits of a rent-to-own: you're going to get phenomenal cash flow from a rent-to-own deal. You're going to eliminate all the tenant and toilet headaches. From the very beginning, rents are controlled with a large deposit. The more skin in the game that they have, the more likely they are to complete the process. Compared to traditional real estate investing, there's a quick turnaround time, and we don't have maintenance to deal with because they sign a maintenance agreement and they're going to treat the home like it's theirs. This is really like taking the cream off the top of a deal, because we do have a defined exit strategy right from the very beginning. This is RRSP, LIRA, RESP, and TFSA eligible. I want to share a concept called the investor food chain. At the top of the investor food chain, we have the capitalist. That's someone like me who sees opportunities and does the work and create the systems to be able to make money. Below the capitalist, there's an investor, and that's who will fund private investments. They like working with the capitalist, and they see the capitalist's vision. Below the investor is public offerings. There are initial public offerings. Typically, most people are not getting calls by their bankers when a company is doing an initial public offering. It's very inaccessible for the average person to be able to get into. There's also preferred shares and public stocks, and stocks can be very volatile and risky. With that recent coronavirus, there was some stock market crashes, so I'm just saying that stocks can be very volatile. Further down the investor food chain, we have mutual funds, which is really a collection of stocks. There are actually more mutual funds in Canada than there are stocks, and we pay the highest fees in the entire world. You don't have very much control with mutual funds. You can't just call the fund manager and ask him questions. You deal with the financial advisor at a bank who sells you into the fund, and you don't really get to talk to the man upstairs. At the very bottom of the food chain, there is GICs and savings. These are typically done with banks. They're considered very safe, but they can be eroded by inflation. Most GICs and savings accounts are paying around 1% or a little more, and with inflation being greater than 3%, that's why savers are losers. Most of the time, these deals at the bottom of the food chain are where most people end up putting their money and using their RRSPs and tax-free savings accounts. What we want to do is bring you from the bottom of the investor food chain to the very top so you can work directly with the capitalist and not have all those fees that are in between. Each man must create his own system, or else he is a slave to another man's. On the left-hand side, we have a bunch of tenant buyers, and on the right-hand side, we have a bunch of houses. When we mix them together, we get rent-to-own deals. This is a little conveyor system showing the process of us merging houses with rent-to-own buyers. We call that our process inside our rent-to-own investment corporation, our deal factory. You're going to have an opportunity to be able to invest money in exchange for shares in the rent-to-own factory. This is the process of how a rent-to-own deal works over the course of 3 to 4 years. We're going to receive a starting deposit, rent is collected, our mortgage gets paid down, the deposit for the buyer is growing, we do quarterly checkups to make sure that everything is on track, their credit is being monitored, and then our buyer is going to be able to get a mortgage and they're going to be able to buy the house, and we're going to collect our payday. This is an amazing opportunity to be able to own the system, which means a piece of every rent-to-own deal. $1,000 into RTOIC is going to get you one Series 1 share for $900, as well as the last $100 of the $1,000 is going to get you a Series 2 share. There is a minimum $5,000 investment, and it can go up in intervals of $1,000. This is eligible for investment with your registered retirement savings plan, tax-free savings account, locked-in retirement account, even registered education savings plans. With over a decade of experience with rent-to-own investing, I've noticed that typically one successful rent-to-own deal ends up turning into two because there's enough capital to do two deals afterwards. The plan with this is to take one side of the equation and be able to return your Series 1 money that you first invested. RTOIC is going to buy back your Series 1 share for the same price you paid. Now the other half of the proceeds, those are going to go back into the system. You're going to still own your Series 2 shares, and now it's going to start paying you dividends, which you're going to profit from. Here's the plan. In between year 3 and 4, we're going to have our first crop of deals coming through the pipeline. And those deals, when they complete, RTOIC is going to be buying back your Series 1 share certificate. At that point in time, we're going to have a bunch of new deals going through the pipeline with your Series 2 share certificate. And it's going to start paying out dividends that are going to increase from 1 year after the other. Your money is going to earn supercharged returns. After 4 years, 90% of your capital is returned. There's a huge focus on being able to return your money as quickly as possible. You still own a piece of the system. That's through your Series 2 preferred shares. You're going to continue to receive dividend payments passively. Your Series 2 shares are going to earn supercharged returns. Let me give you an example of buying $1,000 worth of RTOIC. $9,000 is going towards 10 Series 1 shares. $1,000 is going to buy 10 Series 2 shares. After year 4, RTOIC will buy back your Series 1 preferred share, getting you your $9,000 back. At that point in time, your Series 2 preferred share is going to start paying dividends from all of the rent-to-own deals that are coming through the system. You're going to continue receiving dividends and earning passive income. Let me show you what that looks like. Now, these are projections, but the projection is that after year 4, you're going to earn a 15% return on your investment, or $150. Year 5, it goes up to $300. which is like a 30% return on your $1,000. Year 6, another $300. Year 7, $500. And year 8, another $500. Here is our acquisition plan. We're going to have approximately 120 homes going through the deal factory at all times. This means having about 40 new homes being acquired every single year, and it means that about 40 of those homes are going to be closing every single year. What to do with your capital when you get your big payout? It's your money. You can do with it as you please. You could reinvest and plant another money tree with it. Your Series 2 shares are going to be paying you dividends. You could use that money to reduce your bills, pay for things when life happens, work less, maybe reinvest the dividends. It's your choice what you want to do with your money. The Series 2 shares are going to receive 35% of the net income as a dividend. 70% of the net income after the dividend are going to be paid to buying back the Series 1 shares and returning capital. Series 1 shares are going to be bought back on a first in, first out basis. The system continues to work, generating payouts every single year. So as years go by, you're going to continue receiving dividend payouts. You can sell your shares back to RTOIC. We have allocated funds to buy a certain amount of Series 2 shares back at a higher price. The longer you own the system, the more money is generated. What happens when rent-to-own goes wrong? We do need to talk about it. Some of the risks, because rent-to-own can go wrong, and if you've Googled it, you'll probably find a whole bunch of stories on it. But it can be done right. Regardless of the amount of risk and steps that are taken in the beginning and during a deal, sometimes a rent-to-own goes wrong. This can be from several factors such as job loss, job transfer, credit abuse, a breakdown in the marriage. When a rent-to-own deal goes wrong and the buyer can't close for any reason, we keep the deposit and remarket the property to find another rent-to-own buyer. The deposit can be used to clean up the property if needed. We have a bunch of new home product which can be provided to our buyers from our strategic alliance with Broader Homes. We have a volume discount on new construction. This is wonderful for rent-own buyers because most rent-own buyers don't have the luxury of the choice of a brand new home. This is what the offering memorandum is based on. We could also get discounted pre-owned homes. These would be second-hand homes where we might get a better deal. This means extra profits for RTOIC, which will be passed to all the shareholders. We want to make sure that we're operating RTOIC ethically and with the best intentions. We believe in strong brand reputation and value is preferable and needs to be balanced against any financial detriment whenever possible. We want to work with our tenant buyers to come to a solution, which could sometimes mean extending their deal a bit longer, as opposed to having them go in default. We're also members of the Canadian Association of Rent-to-Own Professionals. They're an association that will audit rent-to-own deals and make sure that they're being put together ethically and that there's a good, strong chance of the tenant buyer being able to buy the home at the end of the deal. Diamond member is the highest status you can get. Here's part of your Rent-to-Own Investment Corporation team. Jonathan Jacobson is also the president of Broader Homes and Developments. He's done over $75 million in real estate deals, and he has a specific focus on alternative real estate deal acquisitions. We have Sean Claremont, who is our president, and he has previous experience in a publicly traded company. He's a very active real estate investor, and he's also has extensive experience in private mortgages, debt offerings, and joint venture structures. Sean also has a master's in business. And we have myself. I'm John Simcoe. I currently work with over 350 private lenders, including those with registered funds. I have over a decade of experience investing in rent-to-own real estate and believe in creating win-win-win opportunities. I have also served as a director and president of the Canadian Association of Rent-to-Own Professionals. Everyone on the team has lots of experience with rent-to-own real estate. We also have RBC as a financing partner. They love the fact that our business model was equity positive and will provide as many mortgages at 65% loan to value as RTOIC requires at great rates. Investing into the Rent-to-Own Investment Company Corporation can be done through a self-directed Olympia Trust account. They're a trust company that started in 1996. They're based in Calgary. They're licensed to conduct trust activities in most of the Canadian provinces. They act as trustee and manage all of the self-administered registered plans. They also prepare all the statements. You can log into your Olympia Trust online portal and you can check to see how your investment is doing, or you can receive paper investments. Where can you find money to get involved? You could transfer money from an underperforming RRSP account, which could be from mutual funds, GICs, stocks. You'll need to sell your stocks or your mutual funds and turn them into cash within your existing registered account, and then you'll have to transfer them over to your Olympia Trust account. You could make a new contribution to your RRSP, and you get a tax credit for making a new contribution, just like you would from any other RRSP contribution. You could take advantage of tax-free returns, which is a really good option if you're considering using cash for this opportunity. You can also use a LIRA, which stands for Locked-In Retirement Account. This could be an old pension or a place you no longer work for. You may have once belonged to a union and they may have some pension money of yours. You can transfer it to Olympia Trust and use it for this opportunity. Who should own a cash generating system? You should, because it takes no time, it can work while you sleep, you receive dividends passively, it takes all the decision making away, and it can pay for things when life happens. You don't need to see the house, not at the time of purchase, not during turnover, and not during sale. Passive income gives you the freedom of time. It reduces your stress and anxiety and fear of the future. It allows you to pursue doing things you love rather than what pays the bills. It gives the ability to live and work from anywhere. It provides a platform of financial stability and growth. Just like the maple syrup farmer, it can take time for a pipeline to develop. The risk is spread out over multiple deals, and you get to actually own the system. Get involved. You can visit our Invest in Rent-to-Own Investment Corporation website and book a time to talk. If you're watching this presentation on the website, you may be on the same page and able to book a scheduled time when we can go over your financial situation and see if this opportunity is a good fit for you. For a copy of the offering memorandum, you can also email me, John, at RTOIC, or Sean at RTOIC.ca. You will feel better after booking the call.